Hello everyone, welcome back to my channel. In today's video, we're going to talk about spreads. Now, I see that a lot of option traders trade the spreads on a day-to-day basis, but to really understand why the strategy works is another thing. So in order to do that, and in order to do that in an intuitive way, let's go back to the fundamentals. So what I have here is some call prices. I calculated some call prices using an example of a strike price trading at $65 with a volatility of approximately 50% and the rate 5%. Now, what I did is I took some strike prices on purpose, one that is at the money, which is $65, deeply in the money 32.5, and out of the money, which is going to be a strike of $80. And I use a time of 0 to a year. The reason why I went farther out in the future is because it's going to help you to understand how really time impacts the price of the calls over time. Okay, so there you have it. Here we have all the call prices for strikes at 3 different levels and farther out in the future. Now, if we go to the graph on the right here, you can see that the gray line represents the one that is in the money, 32.5 strike price. The green line represents the one that is at the money, and the blue line represents the call that is out of the money. So what are some conclusions that we can take right away? Well, you can see here that if we focus on this area here that is farther out in the future, we can see that all three calls basically behave almost as if they were parallel lines. In other words, what that tells you is that the time decay for the three calls is almost the same. Obviously, there is a difference between the three of them, but to us, that difference is very small, and we can see it right here in the graph. That is very important to know because when you are talking about capital allocation, if you're playing with all of these three calls, you have to understand how that capital behave if you are putting a lot of money for an in the money call option versus an out of the money call option. The other conclusion that we can take here is, as we were expected, is if we are getting closer to the expiration date, so here on the x-axis we have the years, if we are getting to time equals 0, we can see that the one that is in the money is still keeping some value, but the ones that are out at the money and out of the money are obviously approaching 0. Now, that is what we would expect, but what we normally don't seem to graph is how that change happens. So for those of you that trade debit call spreads, that is, you initially put a certain amount of capital and you just let time decay do the work. In other words, say, for example, if you are 1 year out and you buy this in the money call of 32.5 strike, and then you sell the one at the money. So after that year goes by, the one that is in the money is gonna lose just a little bit of value, while the one that is at the money, provided of course we're still trading at about the same stock price, is gonna lose a lot more value. But the same thing happens if we are selling the one that is out of the money. And that is very important because sometimes people don't want to sell the calls that are out of the money because they don't have a lot of premium. But right here, you can see that if you go farther out in the future, the one that is out of the money behave almost in the same way that the one that is at the money. Okay, so that is for the debit call spreads. Now, for the traders that are doing the calendar spreads, basically with that strategy, what we're doing is we are always staying on the same strike, and we are just playing with the expiration dates. In other words, say we are in this green line, we are trading at the money calls, and so we buy one that is trading at or is having an expiration date of 3 years out, and then we sell one that is expiring farther closer to the present time. So in that scenario, what we're doing is we're playing with the slope, or we're basically taking advantage of the difference of the slope. You can see here that the slope, as we are getting closer to expiration date, is a lot steeper than if we are here farther out in the future. And so basically, if we move 1 year here, if we buy and then 1 year goes by and we roll that position again farther in the future, if we do the same here, we're gonna have a much bigger credit. So in other words, the same for the same movement in time, this is gonna give us a lot more money than what this change is going to cost us. And let me know if you have any questions about this in the comments. I can show you some other examples. But going back to some of these strategies, now that you understand how these work in sort of an intuitive way, let's see how these work in terms of the numbers. So let's say, and I have here some difference in change of the calls option. So basically, this is what is going to happen when you roll options as you go farther out in time. And I'm going to show you what happens when you do debit spread. So for example, let's say here, what I have here is if you buy the 32.5 and then you sell the 65 dollar strike call option, you basically pay 34.74 and then you sell it for 14.16. That is more or less about $2,000 what this strategy is gonna cost you. Then after 1 year, that call that you sold is going to lose a lot of value. It's going to be traded at about $186. And then that call option that you purchase is going to have lost just a little bit of money. It's going to be trading at $32.53. So in other words, if we look at this change over this change, and we compare it to the initial capital that we put, we are basically looking at about 49, let me clear that formula up, a 49% return. Now, obviously, these have to be in line with the same as stock price. So in other words, the stock price needs to be staying almost equal to what is trading today. Now, sometimes that doesn't happen. However, if the strike price doesn't change that much, this is going to be your overall rate of return. If we, instead of staying in this area, we stay in the second year area. So basically, we buy the in the money call expiring 2 years out, and then we sell the at the money call expiring 2 years out. This at the money call is going to lose this much money, while this in the money call is going to lose that much. That's going to give us at about 20% rate of return. And then as we go with this strategy, as we go further with this strategy, we can see how the percentage changes. So we earn less and less as we just stay farther out of the money. And that is because, again, the calls are sort of like working as parallel lines here. So we don't take advantage of this time decay that we will have with at the money calls and out of the money calls. The other thing that I want to show you here is, what if instead of selling the at the money call, we sell one call that is out of the money. In this case, I did the 80 strike price, which is about like a gain of 20% or so for a strike price of 65. So if I buy the 32.5 strike price and I sell the one that is out of the money, also expired in 1 year out, basically I'm going to gain this $900. And if that expires out of the money, meaning that our stock price didn't reach the $80, then that's gonna be my gain. So if I do that year after year, the first year I'm looking at 26%. If I do that and I stay on the second year territory here, that's gonna be a gain of 16%. And I can continue doing that year after year until the stock price reaches the $80. Or if it doesn't, then I just manage my risk by adjusting the in the money call that I purchased here. And then hopefully year after year, that call option that I sold expires out of the money or very close out of the money. All right, so that in a nutshell is the debit call strategy with numbers. You can see that in theory, obviously this is all in theory and is an estimation of what you can get. We are talking about very high percentages here. And if we played more safely, we're still talking about a very good rate of return if we just stay farther out in the future here. So you don't necessarily need to always take advantage of the time decay and basically stay close to expiration. You can just keep your strategy trading at 2 years out or 3 years out, whatever the last calls are trading at. And still, you're always going to have a gain. Whenever you do at debit call strategy, as time passes, that gap basically solidifies and you can get your premiums in a much better way that if we just continue trading at the expiration date here. The other thing that I want to show you is the difference in rolling calls. So let's say, for example, I'm working with calendar spread. So if I'm in the money, then this is going to be the price of rolling the in the money call. You can see here that it is very cheap to roll calls that are in the money, and they get cheaper the farther out we go. That is a very important information to have, because if you just want to hold calls that are deeply in the money instead of buying the stock outright, that is, I think, a strategy called a stock replacement strategy, where you just buy in the money calls. The farther out you are in the future, the cheaper it is to maintain that call provider. They are always deeply, deeply in the money. And the other thing that I want to show you here is that for calls, this is to basically roll ahead the $80 call, and this is to roll ahead the $65 call. We can see that there is a lot of difference in the first year, but as we go in the second year or the third year, you almost get exactly the same price. So the cost of rolling these calls out in the future are almost the same. And you can also see this here graphically, because you can see how they move almost in a parallel fashion. All right, so I hope this clarifies a little bit why these strategies work, the debit call spread strategy and also the calendar strategy, why this work. Hopefully this give you a hint too of when to use these strategies and when it's probably not paying off the capital that you put into work if you're using any of these strategies. If this was a little bit confusing to you and you have any questions, just leave a question in the comment and I will try to go more deeply into that point that I didn't explain so well. This is obviously a little bit more complicated than what I'm explaining in this video, but hopefully for those of you who are already trading these spreads, now you can understand better in a graphic way why these strategies work and where is more efficient to put them to work. Okay, great. Thank you so much, and I will see you in the next one.